Hello and welcome. My name is Dominic Frisby, and today we ask, when are house prices going to crash? They have to come down sometime, but when exactly? That's what we all want to know. So here is your answer. The declines start in the US and Canada in 2025, and they're followed by the UK, Europe and Australia in 2026. And that is what the 18-year property cycle says, at least. And today I want to explore that cycle and what it says about house prices. Now, the economist Fred Harrison, who first covered the theory in his 1983 book, The Power in the Land, is very much the godfather of the idea that real estate follows a predictable pattern over an 18-year period. I first stumbled across him in 2005, when many people were sure house prices had to come down. Needless to say, they didn't. And he wrote a brilliantly prophetic article in Money Week, I'll put a link in the description, arguing that we were 2 or 3 years from the top. And wasn't he right? Today, by most accounts, property should already have crashed. Real estate bears little resemblance to earnings. With the rise in interest rates that followed COVID, mortgage holders found themselves with higher costs. Some were forced to sell. Prospective buyers can't afford to borrow as much as before. Increased taxes, I'm looking at you, stamp duty in the UK, they've only added to the unaffordability. And yet, despite all of this, while the market may be slow and stagnant in many parts of the country, and indeed the whole world, it is not exactly crashing. But there's one school of thought that was steadfast in all the house price bearishness that followed COVID, saying property's time to crash had not yet come. And they were the acolytes of the 18-year cycle in real estate. And yet again, they have been proved right. Real estate peaks in 2026, they said. And after that, we get 4 years of declines. Now, if you've followed my stuff, you know my views on cycles. We have the seasons, days and nights, moons, menstruation, cycles of life. Cycles are turning around us all the time. And there are economic cycles, investment cycles, the hype cycle, bull markets and bear markets, commodities, super cycles. Gordon Brown was always blathering on about the economic cycle. Mining is cyclical. New technology goes through a clear cycle as it evolves and is adopted. But on the other hand, it's easy to look back at the past, find some random pattern and declare it a cycle. And actually trading them in real time is a very different matter. It's hard. In fact, the human need for narrative and the fact that cycles make for a good story, good copy, mean it's very easy to get wedded to the idea of a cycle when in fact a very different reality is staring you in the face. After 2008, many got it stuck in their heads that it was Kondratiev winter, the next Great Depression, and as a result missed one of the most rip-roaring bull markets in history. So with all that said, the 18-year cycle in real estate has proved remarkably reliable. And Akhil Patel, author of The Secret Wealth Advantage and one of Harrison's great disciples, according to Akhil, it goes all the way back to the turn of the 19th century in the United States. And you can see that. He's got charts, tables showing it in his book. But broadly speaking, there are 4 phases to the cycle and actually lasts about 18 and a half years. Years 1 to 7, silent rally, followed by 2, a mid-cycle slowdown or a dip at the 7-year mark. Then you get the explosive phase. That's when house prices really get on the map. 1983 to 89, 2002 to 2007. And then in the last couple of years, those periods then, and then in the last couple of years of the cycle, you get the classic blow off top, the winner's curse. And finally, you get the correction, which lasts around 4 years. And if you think 89 to 93, 2008, 2011, those kind of times. And then the cycle starts all over again. It's primarily, says Akhil, a North American phenomenon, though Britain and Europe follow the US, and increasingly emerging markets do as well. Now, there is no doubt that the cycle has played out in the UK over my lifetime. The US is typically 6 months to a year ahead. From the mid-1970s through to 1989, there was an extraordinary boom in the UK, followed by that infamous crash, 89 to 93, negative equity, so bad that people posted their keys through the letterbox and walked away from their homes. Prices peaked in the third quarter of 1989 at £63,000, and they fell to £51,000. But in 1993, things got going again, and by the turn of the 20th century, property erotica was all over the television, houses had become financial assets, and today's intergenerational wealth divide was just beginning to show its face. The market peaked in 2006 in the US and in the UK in 2007, Q3, and declines followed. Though in the UK it wasn't such an out-and-out crash as 89 to 93, largely because there were few forced sellers with the slashing of interest rates. And the average house price went from 183 in Q3 to £149,000 in Q1 2009. But they fell by a lot more than 18% if you were a foreigner, as the pound lost a good 30% in the foreign exchange markets. And it would be 2012 before the market got going again. We saw the mid-cycle dip round about COVID time, and now we're in the explosive phase, though in many parts of the country this is one hell of a limp explosive phase. And while prices are rising in some areas, the market is stagnant in others. Now, it's clear from all the leaks that Labour are looking at ways to extract some of the wealth tied up in housing, whether that's going to come from increased council tax, 1% of the levy of the value of the property. That's a number that will only go up in time. Capital gains tax maybe on your main residence, increased tax on buy-to-let landlords, maybe land value tax, increased stamp duty, or by some other means. We don't yet know. The Labour are doing what the Tories used to do, leaking and then seeing what the reaction is. None of that bodes well for house prices, and nor do the plans to increase housing supply via new builds or indeed the mass exodus of people with money that's happening now. On the other hand, lower interest rates, which are coming, should give the market a boost. So overall, my advice to any prospective buyers is to wait if you can stand it. I think this market is primed for big falls, but like the 18-year guys, I don't think these falls come for another couple of years. That said, often not buying a home means putting the rest of your life on hold, which is not a good thing to do. If there's a place you'll be happy in and you can afford it now, then do it. Cost is not always the main priority. And of course, there's always the possibility that the 18-year cycle guys have got it wrong. Thanks very much for watching. Please subscribe, please follow, and I'll be back with another video very soon. Until then, goodbye.